All right, we'll give it just one more minute for everyone to join. Looks like there's a few folks still in the waiting room. All right, looks like everybody's made it in. Hi, everyone. Welcome to today's webinar, our masterclass on retirement planning during uncertain times. My name is Brian C. I'm the founding partner of Capital Stewards. We are professional financial planners and investors who help folks like you make smart long-term investing and financial planning decisions. We're fiduciaries. And so what that means is that we get paid by our clients for our expertise and for our guidance, not for selling products like insurance or high-cost investment funds. We sit on the same side of the table as our clients, and we guide them to make smart financial decisions. Most importantly, we're located right here in Huntsville. We work with families here every day, so we are happy to follow up with you after this, answer questions, do anything we can to get you started on your journey into retirement planning. So in today's masterclass, we're going to roll up our sleeves and start working on retirement planning. It's not a spectator sport, so I hope you came ready to dive in and engage with us. You'll see on your screen the place where you can drop questions into the chat, and then we will field those and we'll try to answer them live, so you don't have to wait till the end for Q&A. We'll do some Q&A at the end, but you can certainly drop them in as you have them, and we'll try to address them. And if we don't get to something, we'll definitely follow up with you afterwards and make sure that you get your question answered. So let's dive in and talk about retirement planning. The Employee Benefit Institute surveys Americans annually every year about retirement, and only 28% are very confident in their retirement plan. That means the vast majority, 72%, have questions. So it's a really big step in your life, and most people have questions about it. I think we have this thing of looking at our neighbors and saying they must have it all figured out, but the reality is most people are trying to solve this puzzle. So before we start kind of digging into the different pieces of the ecosystem that we're going to talk about today, it's important that we kind of take a step back and we think about the big picture. So the first question that I'm going to ask you is, what is your ideal retirement? So I want you to just take a minute and jot down a couple of things that would be markers or milestones or things that you can think of that would be really, really important for you to have your ideal retirement. All right, you don't have to have everything sorted out by now, but at least hopefully you've got a couple of things that you can work from. A lot of our clients continue to work during retirement. I think the definition of retirement has really changed over the last couple of years, and it's really, how do I get to this place in time where work becomes optional, or where I can work less, I can take a step back, I can have flexibility to do the things that I love kind of in the next phase of my life. But there's a lot of people that love their careers. They continue to consult, they teach. We have clients that join nonprofits, they work at a church, they do a lot of different things. You can see on your screen some stats from the Bureau of Labor and Statistics. Workforce participation among adults has risen in each of the last 3 decades, and that trend is expected to continue. And so we actually think that more people will work in retirement. And when those folks are asked why they're working, it's not because they need the money. Most often, it's really about engagement. It's about doing things that they're passionate about. It very rarely has anything to do with their financial circumstances. So as we dive in and think about retirement planning, we are going to talk a lot today about the retirement ecosystem. I think a lot of people are really consumed with the retirement equation, which is some magical number of dollars that we have. We've seen the ads for this before, that if I save X, then everything's going to work out okay. But the reality is, the savings that we're making, how we're investing, our healthcare decisions, Social Security, retirement income, and taxes all play a role, and they all impact each other, and they all impact sort of your total retirement equation or your total retirement ecosystem. So as we dive into each of these areas today, we're going to think about how they impact each other. And so it's really important that you plan for each of these areas and that you build a holistic plan around retirement, and you don't just focus on some number that you've got to achieve. So let's dive in and talk about what is the number one, I think, surprise or challenge for many retirees as they get to retirement, and that is health insurance. For a lot of folks, they want to retire before they're eligible for Medicare. But if you retire before you're at age 65, you've got to have retirement healthcare coverage. For most folks, that comes from their employer. And when they retire, we've got to have a way to solve for that because we're not eligible for healthcare yet. And private policies for a healthy 60-year-old generally cost more than $10,000 a year. So you got to make sure that that's in your budget. That turns out to be a roadblock for a lot of folks. When you turn 65, you have a choice to make. The first option is purchasing Medicare and all of its parts separately. You can see there's Part A, Part B, Part D, and then a Medigap policy. We'll talk about those in a minute. And then the other option is Medicare Advantage. About 45% of Medicare recipients have an Advantage plan. So it's really kind of split down the middle. And there are pros and cons of both options. And so we'll talk about those here in a minute. So original Medicare requires that you coordinate a couple of different plans, A, B, D, and then the Medicare Gap plan. The Gap plan is really important when we're talking about Medicare because Medicare doesn't have a cap on out-of-pocket expenses. You're generally, in your work history, you've been working with an insurance plan that had a cap. It was probably somewhere between $8,000 and $10,000 a year. And when you hit that cap, you didn't have to pay anymore. And so typically you have something like 80% co-insurance that the healthcare company, the insurance company pays, and then you pay maybe 20%, but then there's a cap on that 20% and it's $8,000 or $10,000. Well, when you get to Medicare, there's no cap on what that 20% can be. So if you have a $200,000 surgery, which is not that hard to have, especially as you get older in your life, if you have heart surgery or a sort of a significant condition, cancer, any of those types of things, the bills can add up quickly and you're going to owe 20% of that $200,000 or $40,000. So making sure that you evaluate and find a supplemental plan or a Medigap plan is really, really important if you're going to go the original Medicare path. The second option is to buy the sort of all-encompassing Medicare Advantage plan from an insurer. The choice between the two really depends on your expected level of out-of-pocket expenses, your tolerance for working through a set network of doctors, and your desire for additional non-Medicare benefits like dental and vision coverage, some of those things that you may have had over time as part of your employer-sponsored plan. If you like flexibility, the original Medicare plan with that important gap plan is going to be the best for you. You can go to most doctors. You don't have to worry about the network, and you just have to manage the coverage yourself. If you want the benefits of the plan, so if you want vision coverage or dental coverage or things like that, then that's really where that Medicare Advantage plan will come into play. It's also important to keep in mind that the cost of Medicare varies with your taxable income. So again, we'll talk about taxes more holistically in a little bit, but it's really important to manage your taxable income throughout retirement to prevent your premiums from increasing as you go through retirement. Question coming in, does how healthy you are matter for Medicare versus the Advantage plan? I wouldn't say that healthcare spend or how healthy you are, right? So you're thinking, hey, if I'm not very healthy, I might spend more. I wouldn't say that spend level would drive you to choose Medicare or an Advantage plan alone. I think it emphasizes that original Medicare plan, you need a gap plan. You've got to make sure that you have a good Medigap plan, particularly if you think you're not as healthy and you're going to consume a lot of healthcare. So I don't know that health matters. I think it's really about, do you prefer the flexibility of original Medicare, but the headache of managing it yourself versus, less headache and self-management on the Advantage plan, but less flexibility that comes with it. I think that's really where things sort of shake out. It's less about the total spend that you're going to have. All right, so let's move kind of around our ecosystem map and talk a little bit about spending. There are only really 3 things that you can do with money, maybe a 4th thing. So if you make $200,000 today, after taxes and saving, you're probably spending about $140,000 a year. If you make $300,000, you're probably spending $200,000 a year. That's the actual income that you have to replace in retirement, the income after taxes and after your savings that supports your lifestyle, your giving, pays your healthcare costs, all of those kinds of things. One of the things that we do often with clients is we find that they don't understand what their actual spending levels are. And that's because it's really difficult to look at your checking account and figure out how much you spend every year, because you've got money going in and out of there. You've got money going in through there to go to savings accounts. Then the thing happens to your house that's a one-time investment. There's just lots of activity in there. So it's difficult to look at your accounts, figure out what your spending is. The approach that we typically take is to sort of figure out what we can know And then it makes the spending piece really easy to solve for. So we know how much you pay in taxes because we can look at your tax return. We can look at your contributions to your investment accounts and figure out how much you're saving. And then we know how much you're giving because that's also an item that is part of your taxes. So if we figure out those things, then we kind of know what your spending looks like because it's everything else that's left. And so if you haven't done an analysis like that, that's something we can help walk you through, but it's important to do that kind of analysis so that you know what kind of income you've actually got to replace, because a lot of folks are thinking about that top line number. That's what they make. And that's not really what you have to replace in retirement. So let's talk a little bit about spending. So poll for the group, how much of your current income do you think you actually need in retirement? How much of the current spend do you think that you're going to need in retirement? Just think about that question for a second. So the rule of thumb is 80%. And that's probably what a lot of you would think that's the typical answer to that question, because we've always heard, hey, we don't spend as much in retirement. Research from Chase Bank actually shows that spending increases leading up to and immediately following retirement. So I think that's a little bit of a myth that you want to make sure to placate. What happens is every day becomes a Saturday when you retire. And so you retire and then you want to renovate your house and you want to go on trips and you have all this free time and you start doing stuff and spending money. Now, as you age, your spending will decline over time. That does happen as you get later in life, but it does not happen certainly right at the beginning of retirement. Your spending actually tends to go up a little bit. And as you're aging, you're spending more on healthcare. And so I think it's really important that you be thoughtful about what your spending levels are going to look like in retirement, and don't underassume the level of assets and the level of income you're going to need to replace your sort of pre-retirement expenses, because the actual data shows that you don't spend less in retirement, even though that's a sort of a common rule of thumb. One of the major ways that you're going to fund your expenses in retirement is Social Security for most folks. In fact, for some of you, the total value of your Social Security payouts are going to be several $100,000 and oftentimes over $1 million. So it's really important to get planning around Social Security correct. As you can see from the chart on the right, waiting to claim benefits at 67 or 70 is going to result in significantly higher benefit payouts, especially if you live into your mid to late 90s. So how do we figure out where we want to take benefits and sort of maximize that whole retirement ecosystem? So thinking about your health is the first step to this equation. To break even on the time period between age 62 and age 70, where you see those benefit increases, you're generally going to need to receive that increased level of Social Security benefits for 7 or 10 years. So as we mentioned earlier, it shows that you're likely to live into your 80s, but that's not true for everyone. So if you think you have average or above average health, you're going to live into your mid to late 80s, then you definitely would consider, but not do, and we'll talk about some of the downsides of this in a minute, delaying taking Social Security until you're 67 or 70. But if you've got some health concerns, then it might make sense to start taking it earlier. In addition to thinking about your health, it's important to make the decision around Social Security based on your entire financial picture. You might earn more from Social Security by waiting, but if you're depleting your portfolio, especially if you've got a lot of tax deferred accounts, 401ks, IRAs in particular, if you've got big 401k and IRA balances and you're going to use that to supplement taking Social Security earlier, you may find out that the taxes on those distributions from retirement accounts outweigh the benefit of waiting till later to claim your Social Security. And so the right age to claim Social Security benefits depends on your health, your asset level, and your tax situation. And it's actually different for everyone. For some folks, it actually makes sense on an after-tax basis to claim Social Security earlier. For other folks, it makes sense to wait. And so it's really important to look at everything and make sure that you're maximizing your after-tax income from Social Security, not just sort of maximizing Social Security in and of itself and then cutting a big check back to the government with some of that money that you should be able to take out. So let's dive in and talk in more detail about taxes. High income earners often max out their traditional retirement account contributions without considering the long-term consequences. Instead, we kind of think about retirement accounts in 3 buckets. As you approach retirement, you should evaluate which buckets you want to fill up with savings based on your current and expected future tax rate. And then over time, we'll draw down the buckets in the most tax efficient manner. In years where income is relatively high, We want to contribute to that traditional IRA or 401k bucket. That's where those deferrals are going to be the most valuable. We have really high tax rates, and so we want to reduce our income. However, you've got some years where your income is relatively low. So that's where we want to make Roth contributions, because those are going to be the most valuable thing long term. And then there might be other years where it makes sense to kind of go in the middle and just contribute to a taxable account. And then sometimes you might make multiple kinds of contributions in the same year. So it's usually important for folks to have assets in both buckets, because when we get into retirement, we want to be able to manage what we're pulling assets out of in the same way that we were thoughtful about how we put them into the bucket. So if we get into retirement and all of our assets are in a 401k or an IRA, then we're going to have a really high tax bill, because every dollar that comes out of that 401k or that IRA is taxable. But if we've got assets in a Roth, or if we've got assets in taxable accounts, then we can manage our taxable income and lower our long-term effective tax rate and lower our lifetime tax bill to the government. And so that's really what we want to do. So it's really important to be contributing to all of those buckets and to be thoughtful about how you're making those contributions. And then when you get into retirement, be thoughtful about how we're drawing those things down. Question: if I have a 401k now and I can't contribute to a Roth, where else should I save? Should I think about life insurance? So no, generally on life insurance. Life insurance does have tax benefits, but usually the extra fees and the cost associated with life insurance are going to outweigh the tax deferral. So tax deferrals are a good thing, but they're not the only thing. And if we end up just writing a bigger check to the life insurance company, then it doesn't really help to sort of save on taxes. Nothing is tax free. It's just about managing when you pay taxes, whether we're going to pay them now with a Roth or in a taxable account, or down the road with an IRA or a 401k. So a better option, if you have a high income and you're maxing out your 401k contributions, then the best option probably is a standard brokerage account. You're going to pay taxes on that income, but then you're only going to pay capital gains taxes and probably preferred dividend taxes going forward. So that would be the first place I would look, is on that taxable account bucket on the right. So we talk about investing last. I think a lot of folks come to these webinars and they expect us to talk about investing in retirement. And we're going to talk about investing, but it's important that we understand how, like I said at the onset, how healthcare and Social Security and taxes and all these things fit together to form a cohesive picture around what our retirement is going to look like. And I like to start with this picture of investing, because I think this right here is how we feel about our investments. We want to buy when things feel great. We want to sell when things feel bad. And if we do that over and over and over again over the long term, we're going to go broke, because that means that we are buying high and selling low. And that's not a good long-term investment strategy. What we tell folks consistently is a better approach to investing is that there aren't any secrets, but what you should do is apply wisdom and discipline over long periods of time to achieve your goals. There are 4 foundational principles of investing that we use, that we also think applies to anyone that is investing really in general, and in particular to retirement savers. So the first is that everything starts with goals and objectives. They form the foundation of really good investment decisions. A lot of folks, when they come talk to us, they're on the invest and hope plan, is what I call it, which is sort of like, I save and I invest and hopefully I'm going to have enough money down the road. That's not how really successful investors and institutions invest. What they do is they think about what the goals are, what specifically do we need to invest for, and how can we invest in a way that's going to allow us to achieve that goal with a high degree of confidence. There's no guarantees, but we certainly can build portfolios that are going to achieve outcome with a high degree of certainty. If we know what those outcomes are, if we're just hoping that things go well, it's more challenging to do that. Going back to the goals, once we have really strong goals, we can generally achieve those goals by getting market rates of return over the long term. We don't have to try to beat the market year in and year out to do that. If we can get market rates of return over the long term, we're going to be successful investors. It's really, really difficult to beat the market. You can see the stats there on the success of actively managed funds. Very few of them succeed over time. And yet when we talk to clients, that's generally a lot of times what folks come in sort of to our office with, is a bunch of actively managed mutual funds. And we're sort of like, this is historically, the data says that this doesn't work, right? So we want to have good goals, And then we want to invest and capture market rates of return over time. 3 is get the big picture right. So what matters in investing is asset allocation and being in the market. That's how much stock exposure we have, how much bond exposure we have, how much gold, real estate, different types of stocks, different types of bonds. Again, the security selection, the active asset allocation piece of it is a really small bucket at the top. The vast majority of that investment return is determined by being in the market and having the right strategic asset allocation. And so when you think about your own retirement, that's the question you've got to answer for yourself is what is the right asset allocation for me to have as I go into retirement? And that's what you should be working with your investment folks on, because that's ultimately what is going to drive your success as an investor. And then lastly, we want to minimize taxes and fees. They matter, right? If we can reduce fees by a few basis points, that's going to add up to a lot of money over the long term, several $100,000. And then the same thing with taxes. If we have a really savvy investment strategy, but we're not tax conscious, all of a sudden we're paying out all of our extra gains in taxes. And so it becomes meaningless. And so just in summary, when you think about investing, these are the 4 principles that you should be implementing and that I think all investors would do well to implement. And that's have goals and have objectives, start there. Try to achieve market rates of return, design a portfolio with the right asset allocation to achieve those results, and then minimize taxes and fees to the extent that you can do that. When we stay focused on the long term, it enables us to worry less about what is happening with it enables us to worry less about what's happening in our portfolio. So when we think about investing, if you look, this chart is showing returns from the 1990s to today. And you see stock returns average over 8%, bond returns just over 4%. You can see inflation 2.5%. You can see gold in there as well. The challenge I think that a lot of us get stuck on is that this isn't necessarily how we feel about investing, right? Whoops. All right, we'll go back. We get caught up in the day to day and we get caught up in the ups and downs of markets. And so we don't actually earn that 8%. Morningstar's done research. Other folks have done research on this. Most investors actually underperform the market. And the primary reason that happens is because they try to get in, they try to get out. They don't just hang on for the long term. And so it's really, really important that you find an asset allocation that you can stick with and that will meet your goals, and that you stick with that asset allocation over time in order to meet your goals. And you don't try to get caught up in that fear and greed cycle where I feel good, so I buy, and I feel bad, so I sell, and you destroy value over time. Question about inflation. Could this be like the 70s and 80s? Yeah, so inflation could be higher going forward. But if you just look at the chart that I've got up on the screen now, we had actually flat markets between 2000 and 2009. We had a tech crash in there. Obviously, the tech bubble burst in 1999, 2000, and then we had the global financial crisis in 2008. Stocks still returned, over 8% over that time period. So I actually expect inflation is going to be higher going forward, but that doesn't change the core tenets of being invested and staying invested over the long term, because there will be periods where we'll have really high returns like we did in the 2010s that will even out those periods that have sort of less returns, right, or lower returns. So the last thing that we talk to clients about a lot is safe withdrawal rates. There's a common assumption out there that suggests that withdrawing sort of 3 to 4% is safe for retirement. That's what most sort of endowments use, somewhere between 4 and 5%. Those returns may work in your situation, or they may not. If you get average market returns with a 3 to 4% withdrawal rate, you're probably going to produce portfolio growth over the long term. So you're going to have more and more and more money compounding in your retirement portfolio. And that might be part of your objectives. Maybe you want to have money at the end to leave to your kids. Alternatively, if you start with 6 or 7%, you might run out of money too early. So it's really important to dial in what your withdrawal rates are going to be, to think critically about those things, and then to approach them dynamically over time based on how the actual investment performance looks. So in periods of time where we've had really strong, consistent performance, you can dial up the withdrawal rate a little bit, and you may need to back off a little bit as well. And so again, that goes back to thinking about what your structural costs are, what your budget is, all those sorts of things. So don't assume the safe withdrawal rates necessarily the rule of thumbs there work for everybody, because they might work for you and they might not. It just depends, again, on what your situation is. So lastly, so we go back and just kind of revisit our retirement ecosystem here. So we talked a little bit about spending and living expenses and lifestyle. We talked about income and Social Security. We talked about savings and investments. We talked about taxes, and we talked about healthcare. And hopefully you saw through the kind of this conversation that it is really important that all of those things work together to build a cohesive and holistic retirement plan. And it's not just about sort of hitting a retirement number in order to have a tax efficient retirement. What happens if you want to know more? Well, that's a great question. So you can reach out to us. We would be happy to answer more questions and get you moving in the right direction. The first step is just scheduling an intro call with us. What do we do in an intro call? We just ask questions. We want to get to know you. We want to learn about what your goals are, what you're worried about, what concerns you, what's going well, what's not been going well. We'll talk about any questions you have about us. And then if it feels like after we have an intro call that there's an opportunity for us to work together, then we'll schedule a follow-up meeting and we'll talk about how that'll work. So in an intro call, there's no sales pitch. It's just an opportunity for us to get to know each other and figure out if there's enough there for us to even talk about working together. And what I always tell folks is if you've got questions, we're going to bring answers. And so we'll try to give you some advice in those intro calls as well. If you've got quick questions that we can answer, we're always happy to do that. So if you want to connect with us, you can give us a call, you can send us an email, and we would be absolutely delighted to do that going forward. So, all right. Well, thanks for joining our masterclass on retirement planning. I hope that you found it super valuable, and I look forward to either meeting you or talking to you all down the road.